How much is too much? So 2025 will test an article of faith long held by RBI, the relentless accumulation of forex reserves. So expect the unexpected. That pretty oft-quoted comment by Mr. Chevalier in Oscar Wilde in 1895 play, An Ideal Husband sums up nearly everything written by newspaper columnists since last November when Donald Trump was winning the US presidential elections. So to be sure, anything is possible from him after he assumes offices on January 20. Even so, some actions are most unexpected expected than others. It is virtually a given. For instance, that higher tariffs and accompanying bluster will shake the foundation of multilateral trade. So basically, when Donald Trump will come in office, when he will assume the office as a president on January 20, it might shake the foundation of multilateral trade. Witness the president-elect's threat to slap tariffs not only on China but also on allies and neighbors like Canada and Mexico, as well as his most recent threat of 100% tariffs on imports from countries that try to look for alternatives to dollars like BRICS, originally Brazil, Russia, India, China, and South Africa, and now also Iran, Egypt, Ethiopia, and UAE. So basically, it says here that the direct threat which is given by the president is not only to the China, but also to the allies and the neighbors like Canada and Mexico to get higher rate of tariffs and also 100% tariffs on import for the BRICS countries, and which includes all the Iran, Egypt, Ethiopia, and UAE countries as well. So how can India best prepare to deal with a potential trade war? So this all is happening because of the trade which is going on around the world. And because of Donald Trump assuming the office, there might be some conflict in the tariff rates, which can be faced by BRICS nation along with other nations as well. So how can India prepare for that? Remember, there is a strong likelihood that the dollar will continue to strengthen, adversely affecting not only our trade deficit, as rising protectionism is likely to more than offset any benefit that could be expected from rupee weakness in response to a rising dollar, but also inflows, both a portfolio and NRI remittances, and investors pull out of money in search of safe havens. So there is a possibility that dollar will continue to rise because the supply of dollar will come or will become less in the country due to two reasons. For example, uh, the dollar is rising and also the inflows which happens in the country via portfolio and then NRI remittances, it might not happen to that extent because investors will pull out money and they will be also in search of a place where they can get the maximum deposit profit, right? In the past, the answer was relatively simple, stock up on reserves. So before we used to know, okay, so if this is the thing which is happening, RBI has to stock up its reserves so that in case of the supply when it is getting lower in the country, RBI can sell some of the dollars and then the stability on price and dollar fluctuation might stabilize. So given our overwhelming dependence on oil imports and dominance of the US dollar in international trade, a large cache of reserves was always regarded as the best safety valve. No wonder RBI never lost an opportunity to squirrel away reserves. So RBI very smartly it used to reserve or it used to buy the forex and then reserve it. But is that necessarily the best policy for the future? So for answer, let's go back to first principles. Why do we need forex? The answer to finance current account deficit or the export over of imports over exports. Ideally, it should suffice if we have enough net inflows or reserves to finance our current account deficit. But holding reserves also confers several other benefits. They are a critical component of a central bank's armory, providing insurance against what economists call sudden shocks or abrupt reversals in inflows, reducing the likelihood of balance of payment crisis and preserving economic and financial stability. So it says that holding the reserves might be of might be giving some other benefits also, but there is a critical component such that the insurance which all the central bank provides can give sudden shocks or abrupt reversals in inflows, reducing the likelihood of balance of payment crisis and preserving economic stability. So does that mean we should keep adding to our reserves? Not quite. Holding reserves is not costless. They carry a huge opportunity cost. This is because RBI must deploy them in safe investment avenues like US Treasury bills that give a much lower yield than comparable of Government of India securities. So it says that it's not just the reserves in which we should keep adding, but also holding reserves is not costless. So they carry a huge opportunity cost. RBI deploy an investment avenues like US Treasury bills that give a much lower yield. So it should invest in such avenues, US Treasury bills that gives lower value or the lower return as compared to the Government of India securities. Yours, large dollar reserves are no guarantee of external sector resilience. Washington's readiness to weaponize the dollar in the aftermath of Russia-Ukraine war when the US cut off Russia from the international dollar markets, freezing $300 billion in Russian central bank assets and triggering a default on the country's sovereign debt means accumulating reserves is not a panacea. It says even though US had imposed penalty to Russia about the dollar market and freezed all its assets, uh, it doesn't mean that it is serving as a panacea because even the Russian central bank had all its money frozen in their economy, right? But it was not of any use. So that is how they are trying to link it with the Indian economy also. If RBI holds up the money, it will not much benefit. So if RBI invests in something like US Treasury bills, that might give a lower comparable yield as comparable to Government of India security. So is there a Goldilocks mean when it comes to the size of forest cities? Uh, so is there a Goldilocks mean when it comes to the size of the forest kitty or international we should hold? There are no clear answers. Until the 1991 balance of payment crisis, India's approach to reserves management was based on the traditional approach to maintain an appropriate level of import cover defined as 3 months of import cover, right? So before that, like in 1991 balance of payment crisis, uh, India's approach to reserve management was to hold enough money so as to cover 3 months of imports. Post-reform, this was supplemented by the objective of smoothing volatility in the exchange rate. And though RBI tries hard to deny it, it keeps the rupee dollar exchange rate within a band and sees as a reflective of the real and effective exchange rate, RWR. Okay. So basically, whatever the goods and services we are trying to sell, that is what the comparison here is done. Okay, through this rate. So given the higher interest, hence the interest rate in India, this means RBI must intervene and sell dollars. Whenever market forces threaten to lead to a sharper depreciation of the rupee, then RBI is comfortable with. It means basically if the inflation is getting high,